welcome to Market Catalysts. I'm Julie Hyman. We are 30 minutes into the U.S. trading day. Let's get to the three market catalysts we're watching this hour. First up, the U.S. and China holding trade talks in Stockholm. We'll bring you the latest updates from those negotiations. Plus, breaking economic data crossing the wire, we'll bring you the latest read on the economy with consumer confidence and JOLTS data out. And Boeing stemming its cash burn in the second quarter as CEO Kelly Ortberg looks to turn the company around. We'll discuss that and much more here on Market Catalysts. Let's get a check of the markets right now. We got a mixed picture again today. This is really what we've been seeing as of late, where we have the Dow underperforming typically the other major averages. Today, it's being brought lower by Boeing in particular, which was higher than the shares turned lower, as well as United Health Group, both of which are heavily weighted in that price-weighted average. The S&P 500 sort of a battle today between tech and healthcare on the upside and downside. Tech getting a boost from the likes of Cadence Systems, which reported earnings, and its rival Synopsys, which is rising along with it. And then you've got healthcare stocks lagging on the flip side. The Nasdaq also gaining today. Looking at the bond market here today as well, ahead of the Fed meeting, or the Fed meeting which has begun ahead of the Fed decision and press conference tomorrow. We've got yields coming down a little bit. The 10-year yield right now at 4.38%. Treasury Secretary Scott Bessent and U.S. Trade Representative Jamieson Greer are expected to wrap up a second day of trade talks with Chinese officials in Sweden Tuesday. Joining us now to talk about it, Henrietta Trays, Veda Partners Director of Economic Policy, and our Washington correspondent, Ben Worschel. Thanks for being here. So, Ben, let's start with you. What do we know so far about what, if anything, has come out of these talks?
Nothing yet. It's late afternoon in Stockholm, so this, as you mentioned, the second day of talks are winding down, and we are expecting to hear from Treasury Secretary Scott Bessent and his team in the next hour, with kind of a wrap up of this second day. The main thing people are going to be watching for is this idea of another 90-day pause on tariffs. That would keep tariffs between the U.S. and China at their current rates. That's been signaled as likely from both sides for days now. So that's agenda item number one, as well as a number of other fronts that folks are watching to sort of see what these talks. First and foremost, I would say, is whether kind of a fragile detente over semiconductors and rare earth minerals holds. This is the issue. These are the issues that essentially derailed talks for a couple months, but now there appears to be agreement there, as well as whether this sets up a meeting between President Trump and Xi Jinping later this year. There's some planning there, but there's a lot of scenarios in which the two men get together this fall in a variety of different places. So those are the kind of big three fronts we're watching from Treasury Secretary Bessent in the next hour.
And Henrietta, the view has sort of been that the China talks are the most important, right? That this is where there is the most at stake. Yes, the EU was big, of course. So do you think that anything meaningful will come out of these talks? Do you think it matters as long as they push the deadline out 90 days?
No, I think you nail it. As long as they push the deadline out 90 days and we don't revert to those 145% tariffs that the president sort of escalated earlier in the year, then the market doesn't much care. I think that as we're getting these, quote unquote deals from various nations, from Vietnam to Japan to the EU, the details are critically important, especially for sector analysts around pharmaceuticals and the tariff rates there for semiconductors. We have a mess of information that we are lacking on those fronts. And what's really disconcerting about the last couple of days as these deals have been announced is that the White House will say one thing, they'll put out a fact sheet, and then it's almost immediately refuted by whatever nation we've negotiated a deal with. That's the case with the EU and Japan and Vietnam, all three of those. So the China talks, the street is basically just expecting the president to have gone too far and too much of an extreme with the 145% threat. And so keeping the tariffs at 55% is the best that they can hope for. That is the expectation. The goalposts have been moved, and that's sort of where they are on China.
Yeah, and there has been some reporting over the past few days that the president has offered to pause export controls, for example, as sort of a carrot there. If we look at what has happened with the EU and how it could inform China potentially, Ben, one of the things that we've been talking about as well is not just tariffs and sort of trade back and forth, it's also regulation, right? And the tech industry had been pushing for regulation of their industry to potentially be something that was involved in the EU agreement. And that didn't materialize, right?
Absolutely. Absolutely. Henrietta mentioned the uncertainty that a lot of these sectors are facing. Tech, I think, is safe to say is one of the top ones of there. Digital service taxes have been a giant issue from President Trump's perspective in regards to Europe for months now. He talks about it over and over again as a number one thing he's focused on in these talks. Yet, as we saw in the fact sheet that came out about this deal, it was very vague language. The United States and the European Union intend to address unjustified digital trade barriers. That's sort of boilerplate language. Basically, we're going to talk about this later. We haven't reached an agreement here. So this is a major source of uncertainty for tech, who cares a lot about this. They face fines from Europe over this, as well as I was add uncertainty on the semiconductor front. Semiconductors in Europe are important, but also in these China talks in terms of whether export controls for things like NVIDIA chips to China will continue is a major open question here as these talks go back and forth. So they're going to be watching all these fronts very closely, with the tech industry in particular kind of uncertain where they stand now. Maybe it'll be clearer by the end of the week.
Well, and Henrietta, as we've talked about before, the markets don't seem to be reacting as though this is a negative for the tech industry, for example, right? So, I mean, how do you see that unfolding, not just with the EU, but with China, where obviously tech is also a big bone of contention between the two nations?
Yeah, it's huge for China. And we also have two separate Section 232 and 301 investigations on semiconductors in the works right now. One that's just China focused, and one that's all of the semiconductors around the globe. Another major component here is Taiwan. What is our trade deal going to look like with Taiwan? I suspect that that's going to be very benign, enough to not ruffle any feathers on the China front as they're having those negotiations. And let's also loop in here, just to make it a little bit more complicated, the threat that's now 10 to 11 days away from the president around secondary tariffs, which Secretary Lutnick has said means secondary sanctions on China over its treatment with Russian oil and purchases there to allow Vladimir Putin to perpetuate the war in Ukraine. So there are a slew of various components, none of which I think are going to be able to be something that President Trump tolerates ruffling feathers in China unduly. So what I really mean there is everything needs to be kept at 25% or less tariff across semiconductors, pharma, and all these other issues as they take months, if not the next 3.5 years, to hammer out all of these details. So we've got a lot of time. These deals are not concrete when they're announced, and there are definitely going to be second and third order negotiation rounds. And I suspect that the main goal is just to keep the status quo with China for as long as possible. Maybe Trump gets his meeting with Xi and it's very public and it looks good, but the tariff rates don't come off. There's no certainty as yet, and those are not the conclusions that the White House is prepared to reach right now.
And then, Henrietta, you asked a really interesting question in your latest note, which was, okay, so let's say the negotiations last 3.5 years. What does the next administration do, right? Even if it's a Republican administration, do they keep all of this in place? If it's a Democratic administration, I mean, yes, Biden did keep some Trump tariffs in place, but we're talking about tariffs at mostly a much lower level.
Yeah, absolutely. The Biden tariffs were the Section 301, specifically China facing on $350 billion worth of goods. That's like laughably small compared to where we are now. But nonetheless, Ambassador Tai did escalate those tariffs and really try to put the squeeze on China under Section 301, under the authority of intellectual property theft, forced tech transfer, state subsidization, all kinds of issues that we haven't even discussed on this entire interview because we've moved so far away from those core items originally identified by Ambassador Lighthizer in Trump's first term. So the new parlor game in Wall Street, and I think will ultimately become a major part of the 2026 and 2028 elections, is does the next president keep these tariffs on? The 232 and 301 tariffs are going to stay. We saw that from the transition in the first Trump to Biden to now second Trump term. The IEEPA tariffs are not only subject to review by the Federal Circuit Court, which there will hear oral arguments on July 31st, but the Supreme Court thereafter. And then every single presidential candidate and House member is going to be asked whether they want these tariffs to stay on. They net out to a $2,400 tax on every American household. That's the largest single tax increase in U.S. history. And you don't have to maintain them. They're for international economic emergencies. They're ostensibly over the deficit, and it's not going to be necessary for the next president to maintain those tariffs. So that's the new parlor game in D.C.
And Henrietta, to your point, the sort of bet coming in here with this administration on the part of many investors was that what they viewed as the growth stimulative policies of this administration would sort of outrun the negative effects of the tariffs. But presuming that they do stay in some way, shape, or form, which it seems like they will for at least the next several years, we will have data to let us know if that is indeed the case, right? We'll be able to look at the economic numbers and see if it's worked out that way.
Yeah, and Procter & Gamble CEO just nailed it in the interview right before this one. Tariffs are inflationary. These are costs to the U.S. consumer. They're highly regressive. There is a 37% hike on textiles and footwear as a result of the tariffs right now. And the president's not even done yet. I think the biggest thing for investors to internalize is that this is a border adjustment tax. This is a consumption tax that the U.S. consumer pays. And in 2016, when Speaker Ryan rolled this idea out in the first place, the retail industry went nuts campaigning and lobbying against this. And ultimately, it wasn't included in a bill that needed to pass through Congress. Why? Because the votes weren't there. The members didn't support the legislation in either the House or the Senate side. You had CEOs of Reebok and Dollar General in the Senate saying, absolutely not, this is a tax on my constituents. The president has superseded Congress, and that's what the Federal Circuit Court will judge on. They have superseded Congress and acted via executive authority in a way that has never been done before. And there's no reason that it needs to be maintained. The goal of these tariffs is to collect revenue, not to go to zero, which is what Secretary Bessent was fond of talking about back in January and February. Right. We're going to be stuck with 15 to 25% tariffs at a constantly fluctuating rate across every trading partner on the globe. It doesn't have to be this way.
It doesn't, except the president wants it to be that way. So for now, it is. Henrietta, Ben, thanks a lot. Appreciate it.
Thanks for having us.
We just had some breaking economic data crossing the wire. Job openings, also known as JOLTS, missing estimates, coming in below the 7.5 million economists had estimated at 7.44 million. Job openings falling in June after jumping in each of the prior 2 months, keeping the overall level in a consistent range over the past year that could indicate generally stable demand for workers. The report supports the characterization of a cooling labor market, but only gradually. Job openings remain above average levels seen prior to the pandemic, suggesting there is still a relatively healthy demand for workers. Treasuries rallied on the dollar and stocks as that number came in above 7.4 million, but below the estimate. And we're looking right now at Treasury yields pretty much where they were before the report. Meanwhile, Conference Board consumer confidence data beat forecasts, and we're going to speak with senior economist Yelena Shulyatyeva later this hour. An $85 billion deal in the rail sector. Union Pacific agreed to acquire Norfolk Southern in a cash and stock transaction that will form a transcontinental rail giant in what stands to be the industry's largest deal ever. The merger would create the United States' first coast-to-coast rail network spanning 50,000 miles in 43 states. With a total enterprise value of $85 billion for Norfolk, it is the largest deal of the year announced so far, according to data compiled by Bloomberg. The deal comes a year after a dramatic activist fight at Norfolk Southern and a subsequent ouster of its CEO. It narrowly fended off investor Ancora, which won 3 board seats. The deal raises competitive pressure on rivals, including CSX and Berkshire Hathaway's BNSF, to potentially pursue deals of their own to keep pace. Historically, rail mergers have been difficult to do, but the industry is hopeful that the Trump administration will be friendlier to industry consolidation. The deal would put around 2/5 of rail freight in the hands of one company, raising concerns that it would reduce competition in a crucial industry. The combined company would have over 50,000 employees, 4/5 of whom belong to unions. Coming up, has Boeing finally reached an inflection point? The stock had been rising after earnings. Now it's turned around. We'll do a deep dive next. Boeing beating second quarter expectations as the company slashed cost and aircraft deliveries picked up. This as CEO Kelly Ortberg continues his turnaround plan, saying the jet maker can, quote, make 2025 our turnaround year. Joining me now, Yahoo Finance's Pras Subramanian and George Ferguson, Bloomberg Intelligence Senior Aerospace, Defense, and Airlines Industry Analyst. Guys, thanks for being here. Pras, I want to start with you. Sort of give us the bullet point takeaways on these results and what we need to know.
Yeah, I mean, I think that turnaround plan like that Orberg had mentioned is working. I mean, revenue up 35% compared to a year ago, narrower core loss per share than expected. But big is that I think that big point is that cash burn cut to 200 million in Q2, a massive improvement compared to the 2.3 billion burned last quarter and 4.3 billion burned a year ago in the same quarter. So that's really changing the dynamics there. What's helping there is they're delivering more planes. Finally, 150 deliveries in Q2. They hit 38 737 MAX planes per month in Q2. So, Orberg optimistic here, saying that the start of the second half of the year, we're moving in the right direction ahead of where I thought we'd be in a recovery. If we continue to tackle the important work ahead of us and focus on safety, quality, and stability, we can navigate the dynamic global environment and make 2025 our turnaround year. So strong statements here for a company that a year ago was struggling pretty much.
And it's also kind of remarkable, George, the cash burn that has turned around now and was positive on an operating business in the on an operating basis in the quarter. How did they achieve that, and can they sustain that?
Yeah, so agreed. I think that that cash generation number is one of the most key metrics to watch for Boeing. It was all about deliveries, right? Deliveries are rising. Most importantly, the 737 MAX, that's their moneymaker. They had a bit over 100 deliveries this quarter. We think they could have 135 or so of those deliveries next quarter. We're looking for them to double those deliveries this year. That's going to help them continue to generate cash. They've got a lot of inventory in the balance sheet, $89 billion, tens of billions of dollars above where it should be. And as they deliver these airplanes, we think that they won't bring the suppliers up as quickly as they start to deliver airplanes and bring down that inventory and continue to unlock cash. And that cash is going to help them improve the balance sheet. So everything I saw in the quarter looked like the turnaround is continuing to progress.
George, I'm curious how much of that deliveries boost was a result of some of the strong arming on the part of the U.S. administration trying to increase deliveries from other countries, and if so, how sustainable is that?
Yeah, I mean, I think they dial in these deliveries. I think they actually start cutting sort of airplanes and building components a couple of years out. Some of the long lead time items. So I think it'd be hard for the Trump administration to sort of strong arm and get these deliveries sort of pushed up in short order. I mean, one of the concerns, though, around deliveries would be the tariff situation. Boeing has a really important customer in Europe, Ryanair. We didn't see any deliveries in the last month. And it seems like the tariff situation is sorting itself out. And I think as long as that tariff situation continues to sort itself out, you won't see Boeing building airplanes and parking them on their tarmac, right? They need to get them delivered to the customer to get the cash. That's the one thing I think we're a little bit concerned about, but so far it seems to be working fine. So, I mean, I think they're going to do all right getting deliveries out the door this year.
Pras, did we hear much commentary from I guess that we're waiting for the call to start, but even in the statement and in anticipation, did we get some commentary around tariffs?
Not that I could see at the moment. I mean, we know that EU US preliminary deal is in place for 15% tariffs. That's the sort of big overhang that's sort of been removed that George is alluding to. So that's positive news for Boeing. And I think with regards to deliveries, George, correct me if I'm wrong, but I think something like less than 10 of those jets this quarter were from like the stuff that's been sitting on the lots, and the rest of it's all like new builds, if I'm not mistaken. So I think that's showing that the company is sort of pushing forward with all the newer orders, and they don't have that many left in the parking lots, right?
Yeah, I mean, those numbers sound about right. And I think besides those built aircraft that weren't delivered, there's a bunch of inventory, again, they've got sitting on shelves. That 89 billion indicates to me that they have parts of airplanes that they purchased from suppliers to keep them healthy that are somewhere on Boeing's premises, definitely on their balance sheet, that they'll, even though they don't have sort of built, ready to deliver airplanes that are coming out of inventory, they have components, and that will still juice up that cash flow through the year.
George, what's your view of where they are on their sort of engineering and safety progress turnaround? I mean, I know that they're still waiting for certification of a couple of their 737 MAX models, which they now say they're expecting next year. Do you feel like they're on the right track on that front?
I mean, it seems to us like they are. I don't think they could get deliveries going to the extent they have without getting the quality cured down at Spirit Aerosystems. And all the commentary we're hearing from Spirit Aerosystems is that quality is improving. I'm hearing a little bit of rumbling in the marketplace about certification of the 737-10 and the -7, that perhaps it's going to slow a little bit, but I haven't heard that it's going to materially slow. Look, I mean, I think getting things through certification, it isn't always a straight line. And we're going to watch that closely because that 737-10 is a key competitor for the Airbus A321, which is a very, very popular airplane. One of the reasons that United went to Airbus to get those A321s, because they were unsure of that certification. So we're going to watch that closely, but it feels to me, again, from the quality coming out of Spirit, from the deliveries rising, that they are putting these problems behind them, and now I think we'll watch that certification closely.
Yes, we will. Prost, George, thank you so much. Appreciate it. Coming up, a look at the day's top trending tickers. That's next when Market Catalyst returns.
Welcome back to Yahoo Finance. I'm Brooke DePalma, live at the NASDAQ. Let's get a quick check on the markets to action about 1 hour into the trading day. Let's take a look at the biggest market moves here. If you take a look at the NASDAQ, that index opened up 0.5%. Now we're scaling a bit back here as we digest that. We're going to get a few tech earnings out this week. Meta, Microsoft set to come out after market close on Wednesday. Amazon and Apple, those are expected to report on Thursday. Now that NASDAQ, once again, very focused in on those big tech names, up about 0.1% as we make our way into today's trading session. Let's take a look at the S&P 500. That index trying to hold on to the momentum there as we make way into today's trading sessions. Any gains there at the end of today's market session will mark another record high. On Monday, the index closed at its 6th all-time high, closing high in a row. So we're going to be looking out for that index as well. Let's take a look at the Dow. The Dow getting dragged a bit lower today after opening up in the green just ever so slightly. I want to take a look at the heat map here of what exactly makes up the Dow. If we go to the equal weight index here, what we're seeing is Boeing really dragging down on the Dow today. If you take a look at the stock here, it really opened right there, as you can see, in the green. But then, as we heard more from the company, they did report a loss of about $176 million. Of course, they're in the midst of that turnaround story here. And we've seen that company really struggle to rebound, or rather, year to date, it's up more than 30%. But we've seen that really struggle to rebound, especially over the past 6 years, as that company back in about 2018, 2017 had led off with that MAX 737 crash that has since, been ongoing problem for the company. Also weighing on the Dow this morning is United Healthcare. That stock down more than 4% in today's trading session as the company warned that its insurance unit is facing higher medical costs. That stock has been under pressure year to date, down more than 46%. Those are two companies we're keeping a closer eye on. Also, very quickly, just want to hit on gold futures. What we're really seeing there is this gold future rally. Year to date, we've seen gold really move higher, as seen as a safe haven for investors. That getting a bit of a move here. We're hearing from Fidelity saying that gold futures could hit $4,000 an ounce by the end of the next year. Goldman Sachs also out with that reading. Citi a bit bearish, saying that it will hit an end of the year high of $3,315 an ounce. So certainly something to look out for. Keep it right here on Yahoo Finance. We'll be tracking all the market moves throughout today's trading session.
Now time for some of today's top trending tickers. We are watching PayPal, Sarepta Therapeutics, and JetBlue. First up, PayPal topping estimates in its second quarter and lifting its full-year guidance as its Venmo business reported its highest revenue growth since 2023. But despite these positive headlines, a slowing in transaction margins growth, as well as lower free cash flow, they're weighing on the shares, which are down by nearly 9% right now. Next up, Sarepta Therapeutics shares soaring on news the company will resume shipments of its top-selling muscular dystrophy therapy in the U.S. That's after the FDA reversed its request for a voluntary pause on the drug. Shipments to patients who cannot walk independently are still halted after 2 teenage boys died earlier this year. Finally, JetBlue topping estimates and reinstating its guidance as the demand picture improves for airlines. Despite the pickup in bookings, JetBlue expects revenue per available seat mile, that's the proxy for pricing power, to decline between 2 and 6% next quarter. The company also announced clearance from the Department of Transportation to move ahead with a partnership with United Airlines. Those shares up almost 2%. You can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Coming up, what the latest data shows us about the health of the consumer. Stay tuned. Consumer confidence ticked slightly higher in July, coming in at 97.2. That's compared to a revised reading of 95.2 in June. Consumers felt less pessimistic about the future, but concerns about tariffs, high prices, and inflation persisted in the past month. Joining me now with more on the latest reading is Yelena Shuryetyeva, the Conference Board Senior U.S. Economist. It is great to see you. Thanks for coming in.
Great to see you. Great to be here.
So a little bit of improvement here. How does this sort of compare with the long-term average, and what does it tell us in general about how the consumer's feeling?
It's an inch higher. It's a very small increase. So the levels remain quite depressed by historical standards. And if you look at a kind of like a longer history, it's really not where you would like to see that in an expansion. So I think that, consumers are just taking a pause from, all these tariffs and fiscal developments and just kind of setting back a little bit, like, okay, it's a summertime, so let's see what happens. But there's still a lot of uncertainty. And there is still a lot of uncertainty about the labor market. And that's what we see in our numbers, with the labor differential falling for the 7th time in a row.
So the labor differential, which I know economists watch very closely here, it's what, between?
It's jobs plentiful minus jobs hard to get. So basically the index just tells you how available the jobs are. So, and consumers are finding that jobs are becoming less and less available. So that's what the index shows. And that is actually very much in line with what we saw in the other report that was released this morning, the JOLTS report, where vacancies declined below 4.5%. So that's kind of a concern.
How does that trajectory usually play out? Do you usually see sort of fits and starts in that jobs differential? Or once it starts narrowing, does it tend to continue?
I think that's the latter. But I think, it's very important to see that trend persists, right? 7 months in a row, it's kind of telling you something. So the layoffs rate is still low, but the hiring rate as well from the JOLTS report, that declined. So this all tells us that the job market is becoming less and less available. It's harder to find a job once you become unemployed, even though the companies are not laying off people. So it's kind of that fragile status quo where the job market is. And obviously we'll see another payrolls report on Friday.
We will. And on the tariff and inflation side of the equation, there the perceptions seem to have improved a little bit. But just like the Fed, I'm sure, is going to remind us again tomorrow, we're still waiting, right? We're still waiting for tariffs to really fully make their way through to prices. Does that then portend maybe we could see another price increase and another hit to confidence?
It's interesting in our survey that the write-ins were still high for tariffs, like a lot of mentions of tariffs, but this seems to be moving into inflation. So the mentions of inflation have increased. So do people think that, okay, tariffs will mean inflation? Probably that's what it says. So I think we saw signs of tariffs passing through inflation already. We saw that in goods price increases, we will see a relatively high increase in PCE, price deflator, on Thursday as well. So I think we already see signs of that, and we will see more in the third quarter of this year.
All this year, we've seen this pattern in the past several years, right? We keep sort of waiting for the economy to maybe worsen, and it doesn't seem to be materializing. Is there anything in this report that helps explain why there has been this seeming resilience?
Consumers are still spending, although they're spending at a lower rate. So in the GDP numbers that will be released tomorrow, the headline number will be very strong given that imports are plunging. But if you look beneath the surface, you will see that private demand is slowing, including consumers. Yes, Q1 was weak for consumer spending. We'll see a little bit of a higher rate in the second quarter. But overall, for the first half of the year, consumer spending is much slower. And we will see slower growth in the second half as well. That's what we expect. So consumer confidence numbers are not bad, but they're slowing. They're telling us consumers are becoming more and more cautious. I think that's what it's reflecting.
And I note that you say slowing, but we've seen many economists, if not taking the recession probability off the table, they're certainly saying it is much, much lower than it might have looked.
We're in the same camp, no recession, but we're definitely expecting slower growth this year overall than we saw last year, for example.
Right, makes sense. All right, thanks, Yelena.
Very
Good
nice to see you.
Well, the FOMC policy meeting is underway in Washington, and investors largely expect the Fed to hold rates steady. Yahoo Finance's executive editor and opening bid host Brian Sazzi spoke to Torsten Slok, Apollo chief economist, about the Fed's rate path and whether the U.S. economy is heading for a recession. Apollo, by the way, the parent company of Yahoo Finance.
Does this economy, I mean, I look at retail sales, PPI, CPI, I hear corporate earnings. They've been quite good as they've hit the tape. Does this economy need a rate cut like the president has suggested?
Well, you're right. Retail sales that came out for the month of June was actually quite strong. Inflation is still relatively well contained. It did go up in June a little bit in those categories that are impacted by tariffs. So taken together, the incoming data is actually still okay. So from that perspective, you're right. I mean, the economy doesn't seem to be slowing down. So if it's not slowing down, why should we be cutting interest rates? So from that perspective, it is absolutely clear that at this point, I think the Fed is not going to go out and say we're going to cut rates here in July. And the market is only still pricing a 53% probability of a cut in September. And that's been really there between 50 and 55% for the last several weeks. So you're right. There is not a strong argument for a lot of rate cuts at the moment. That's why our view is that they will only cut in December and then they will only cut twice next year, because we still have solid growth and we still have the risk of upward pressure on inflation, not only from tariffs. Let's also not forget that there's also upside pressure on inflation from two other sources, namely from immigration restrictions. Because of deportations, at the moment, the goal is to deport around 3,000 people every day. If you multiply that by 365, that gives deportation of around 1 million people a year. If you lower the labor supply, that means that you will see more wage inflation, especially in the areas where unauthorized immigrants work, namely agriculture, construction, leisure, and hospitality. So if that's the case, there's also some upside pressure, especially on services inflation because of deportations. And finally, the dollar going down is also creating some upward pressure on inflation. So the inflation pressures are likely to the upside. The labor market is still relatively decent, and that does argue for fewer rate cuts than what the market currently is pricing, in my view.
And of course, Torsten, we're less than a year into the second presidency of President Trump. But my question to you is this: has the Trump economy, has it surprised you? You mentioned we have people being deported, yet we have the labor market still posting non-farm payroll gains over 100,000. We have tariffs in place, plus trade uncertainty, plus we don't know where these tariffs will end up, yet the economy is still growing. Like, have you been surprised by this?
I have been surprised by that, and the Fed forecast, the changes they have made, shows that they have also been surprised by this. And the consensus forecast, which, if you look at what the blue chip consensus was expecting earlier this year and even earlier, just in the going into the second quarter, it was clearly the case that there was an expectation that we would see more of a slowdown. So in the simplest language, the pig is coming through the python, but it's taking a lot longer to absorb the pig here, and maybe the negative effects of that trade war shock that we all have worried so much about is just going to take longer to play out. So that's why you're right. The resilience and the remarkable resilience of the economy that we've seen, especially here in the last few weeks, just continues to be very positive and very good. And if this continues, then there is less needs for rate cuts, because now we also have that the tax cuts and everything that came from the one big beautiful bill will eventually, as we get into later this year and into next year, begin to provide a boost to GDP growth, which is an offsetting factor from the downward drag that we should have seen from the trade war. So yes, the economy has been very resilient, and that has been surprising to everyone.
I'm just going to just go off the assumption that tariffs are going to be in place for as long as President Trump is still in office. Unclear what the rates are going to be, but assuming that, can we rule out a recession over the next 12 to 18 months with tariffs in place, with various other policy uncertainties?
Yeah, so this is really interesting because the consensus that just came out in terms of what does the consensus think is the probability of recession in the next 12 months, and the consensus is saying there's a 35% chance of a recession in the next 12 months. That's actually really, really high. Our Apollo view is that that number is closer to 20% chance of a recession in the next 12 months. So it's not quite zero. There are still things we worry about. A number of those things, including other things that we have not talked about yet, is that we're also facing a new headwind because of repayments on student loans starting for a long time during the pandemic. You didn't have to pay your student loan back, and it did not have any consequences for your FICO score. Now it is the case that you need to pay back your student loan. If you don't pay back your student loan, your FICO score will go down, and potentially, according to the New York Fed, as much as 75 points. Let's say my FICO score is 725 and my FICO score goes down 75 points. That means I could go down to 650 on the FICO scale. That means that there's a lot of people, as much as 11 million households, who are now not paying their student loans or 90 days behind on their payments, who are now at risk of not being able to go out and buy a car or buy a washer and dryer or iPhone. So now another headwind to consumer spending is that we're also seeing student loan repayments beginning, potentially also weighing on the economy over the next several quarters. So the bottom line to your question is, it makes sense to worry about the trade war. It makes sense to worry about immigration restrictions, deportations. It makes sense to worry about student loan payments. But overall, this is more like a Nike swoosh, not a recession, but a Nike swoosh where we have a slowdown over the next several quarters, and then we start to recover again. But there are some headwinds now that we do need to take seriously. And some people put a lot more weight on them than I do and say that the risk of a recession therefore is higher. But I think the recession probability, to your question, Brian, has come down and is lower today than where it was just a few months ago.
Spotify shares are under pressure after missing estimates in its second quarter, snapping the recent rally that shot shares to all-time highs. Yahoo Finance senior reporter Ali Canal has been tracking this story, so the share's down 10% right now.
10%. Now, heading into this print, we had been up around 120% over the past year, and that comes as this company has really shifted focus. They've pulled back on that aggressive podcast spending that we saw. They refocused their energy on margins. We saw layoffs. There was just a lot of tailwinds for this company, especially on the heels of AI as well. So the fact that we are seeing this dip today is not totally surprising to me given the valuation. However, we did see a disappointing report as well. We had earnings swinging to a loss. We had a weaker forecast for the third quarter. And I think when we look throughout this earnings season, it all has to do with guidance. And if you're a company that's pulling back on guidance, why are you doing that at this point? What reasons are you giving? It was interesting on the call that they were asked a lot about price increases. And you're at a time when you have a lot of competitors, YouTube, Apple, aggressively raising prices at a pretty quick rate, whereas Spotify has been a little bit more selective. Now, CEO Daniel Ek, he has maintained that Spotify does not want to consistently raise prices to the point that they're losing customers. They said it's better to have retention than to have to reacquire customers later down the line. So those are all levers that the company could pull. It seems like at this point, they don't want to pull them just yet. And obviously a big focus, as always, is on those gross margins. Spotify laid out a plan in 2022. They want margins over the long term to be between 30 and 35%. And we have reached those levels. We saw a record in the fourth quarter, but we did see that dip in Q2, 31.5%, and we are expected to dip further in the current quarter to 31.3%. So as this company is really ramped up, we finally are profitable, investors don't want to see any reversal in some of those profits. So that's why you're seeing shares under pressure today. But Wall Street overall looks pretty bullish. JP Morgan reiterating their outperform rating, saying that looking ahead, it's really a top pick when it comes to AI. And again, a lot of those tailwinds that we talk about consistently.
Yeah, and as we mentioned, the stock has also done well going into this. A headline caught my eye to do with Spotify, in part because I'm a fan of this band, which is called, wait for it, King Gizzard and the Lizard Wizard. It is an Australian rock band. and they are saying they're in the process of pulling their music from Spotify. In this case, they say it's because of founder Daniel Ek's investment in an AI drone company. So it has to do with sort of a war position here. But obviously this is not the first time or the only time that various artists have pulled their stuff from Spotify. Overall, have we seen it have an effect?
It hasn't seemed to have an impact on shares. However, we do know that these things are in the headlines. You saw Taylor Swift pull her music. That was over compensation.
That was probably a little bit of a bigger deal than this one.
Probably a bigger deal than you had during the COVID pandemic. Daniel Ek standing firm in the fact that Joe Rogan and his misinformation claims about COVID-19, that he wasn't going to pull those episodes, and then you had Neil Young and other artists really stand up and pull their music. So this is a company that is very exposed to their artists, and they ultimately need to keep the artists happy, also the labels happy as well. So that is certain points in this company's history, you've seen it struggle with those types of conversations and those types of deals. So this, I think, speaks to the larger issue here when you have a company that is so exposed to artists and you have a leader like Daniel Ek that really doesn't back down when pressured. How does that translate into share price reaction, and how do investors react? And we have seen investors look at these issues before and, react and pull their money away. Doesn't seem to be the case this time with shares at record highs, but still something to keep an eye on as we continue to track a lot of these developments and how executive leaders really weigh in on some of these conversations that are in, the zeitgeist right now.
Yeah, definitely. Thanks, Sally. Appreciate it. Coming up, full market coverage ahead in the second hour of Market Catalyst. Don't go anywhere. This hour on Market Catalyst. First up, the Federal Reserve kicks off its two-day meeting in Washington. We'll discuss the Fed's rate path and how investors should position for the next rate decision. Plus, we'll sit down with the CFO of AstraZeneca after the company posted strong second quarter results. How is its expansion into the U.S. helping its numbers? We'll discuss. And we'll bring you 3 charts you need to see on stock market valuations. Is big tech's rally echoing the dot-com bubble? We'll talk about that and much more on Market Catalyst. 90 minutes into the start of U.S. trading, I'm Julie Hyman. Let's get a check of the markets here. We're taking a look at the major averages that are mixed and are now actually more mixed than they were earlier. That is, the S&P 500 has come down from a modest gain to now trade little change. The Dow under pressure, as we've been talking about, from Boeing and United Health today. It's off by about 142 points, 0.3%. The Nasdaq barely holding on to its gain at this point, even with strength in some tech stocks, not the sort of Magnificent Seven, but some others that came out with earnings today. Well, the Federal Reserve kicking off its two-day meeting this morning in Washington, D.C. Despite President Trump's best efforts, the central bank's expected to hold rates steady. But is that the right move, and what are we going to see from here? Joining me now, Stephanie Roth, Wolfe Research Chief Economist, and Kelly Kowalski, Mass Mutual Head of Investment Strategy here in the studio. Thank you so much for being here. We appreciate it. So I guess the first question is, we're pretty sure that the Fed is not going to change anything today. Stephanie, do you still think that's the right move, given the information that we have right now?
Yeah, I think we don't really know the extent of the tariffs and at least the impact on the economy. We've measured how much tariff absorption has taken place so far. Our estimates suggest it's about 30%, which tells us there's 70% remaining. So we might see a summer where the inflation data start to surprise to the upside. At the same time, travel goes the other way. In which case, we'll be sitting here in September and the unemployment rate might not be that high and inflation's a bit sticky. So it kind of makes sense for them to just wait and see how the trajectory of the data plays out in the next couple months. And then we'll be sitting here in September. Our base case is they still don't cut then.
Yeah, what do you think?
I have to agree with that. I think September is only 6 weeks away. We have 2 more job prints, 2 more inflation prints. At June, the stance was kind of wait and see. If we look at sort of what's happened since then, we had a June report that showed some uptick in goods inflation. Economy's resilient, markets are strong. Wait and see is the right call.
And so if all of this is the case, we were talking earlier with our Josh Schaefer, who just put together our big chart book, which is our annual collection of charts that tries to reflect what's happening in the markets and the economy. And he said he got like 1 or 2 Fed charts this time. Usually he gets 5 to 10. Does that also reflect, Kelly, that right now, at this moment, the Fed is just not as important a market consideration because it's on hold?
I think that the Fed is still important. You certainly see markets kind of trade around rates, but really the number one focus now is tariff uncertainty. I think we're sort of past the peak uncertainty, and fundamentals in earnings season, because what ultimately informs what the Fed is going to do is the underlying fundamentals of the U.S. economy and how well sort of healthy markets are functioning. And that's our priority sort of at MassMutual that we're looking at. So we look at that first, and that's sort of feeding into the Fed decision secondarily.
Yeah, well, given that, I mean, August 1st is Friday. And even though we've had some deals, and we're going to talk more about trade with China in just a moment, but even though we've had some deals, Stephanie, the tariff rates are kicking in, many of them on the first, even with some of the deals that have come into play. So what then is the feed through to inflation, and how long do we still have to wait to figure it out?
Yeah, so we had outlined a couple of weeks ago a base case and then bull and bear cases. Mm-hmm. And the way the tariff trajectory has played out, it's actually worse than our worst case. That said, we'll probably see it impact slowly throughout the economy. And inflation, we're going to look at inflation a little above 3% over the next couple of months. So not great, but it's not a total disaster either. The economy is still fairly resilient. We're just going to be sitting here with slightly sticky inflation. I think that's where markets might have to adjust to some extent, because the market is still looking at cuts for this year that will probably have to get priced out. So we might just be sitting at one point over the summer where markets have to digest the sort of the rate move that might have to play out at some point.
So that's the inflation side of the equation. I want to ask you a little bit more about the labor market side of the equation, because last time we talked, you were seeing some signs under the surface maybe that we needed to pay attention to. We earlier talked to the chief economist at the conference board. We got consumer confidence today. We got JOLTS today that are maybe showing further signs that we need to pay attention to what's going on in the labor market. Do you think we're seeing a little bit of deterioration there?
I think at the margin, but that was largely expected this year anyway, right? We're sitting here in a labor market that was very frothy. If we continue to run with that type of job gains, we would have had a real tightening in the labor market, and that would have been an issue. So it's good that we're seeing payroll slow down. Our base case is that on Friday we get 80,000 payrolls. Part of that has to do with some seasonality that we got last month that artificially boosted the print. But we have to see payroll slow down because immigration has slowed down pretty substantially. So we're likely to be sitting here with payrolls running in the 75 to 100,000 range for the next couple of months, and that's not an issue. The real thing to focus on is the unemployment rate, and we're not seeing layoffs pick up, which means that the Fed can stay on hold, and there's no critical issue coming from the labor market really by any means.
So is there any reason, Kelly, that stocks won't keep going up and hitting record highs every day?
Well, I think the one thing that everyone is citing, and we actually see it in credit markets as well, is that valuations are extended. But as we know, high valuations can persist through time. We look at credit spreads at MassMutual, which is a spread or a measure of risk or stress in the market. And they're telling us that risk and stress is lower than it was at the beginning of the year. So you can cite valuations, but again, that can persist through time, and the fundamentals remain okay.
And so where do you want to be positioned as an investor?
Yeah, so when we're sort of thinking about sectors, obviously tariffs are still front of mind right now. We're staying away from, sectors that there's still a lot of uncertainty, like autos, metals and mining, healthcare, for example, still some uncertainty there, more, domestic related. But we really like exposure to, sort of the structural tailwinds of the AI build out. We like utilities, parts of the energy sector like midstream that really have just defensive characteristics and sort of those tailwinds, because we know demand for AI is going to drive a lot of electricity demand as well.
Well, it's interesting that you talk about the sort of sector split, if you will, because we've heard anecdotally from companies, even just in the last day, right? We've heard from Procter & Gamble, we've heard from Whirlpool, where they are seeing tariff effects. So when you're doing your economic modeling, do you just say, okay, that's just a limited effect at this point? It's not a bigger economic pressure?
I think what we're going to see is it gets split amongst the three main sources of the sort of supply chain. So the exporters, the retailers, and then the consumers. And when we look at that so far, we've seen a lot of the impact hasn't been felt yet. So that's still ahead of us. The exporters are call about 10% of the brunt of the impact so far. And the rest has been split between retailers and consumers. And we're likely to see a lot more of that. And to the extent that exporters still remain kind of continuing to pass on the rest of the cost, then we're going to see a lot more from the retailer side and a lot more from the consumer side. And the impact should be pressure margins, and it should also boost consumer inflation as well.
Something to look forward to. Kelly, thank you so much for being here. Appreciate it. Stephanie, you're going to stick around. We got much more coming up. We're going to talk more about those talks happening in Stockholm between the U.S. and China. We'll be right back.
Welcome back to Yahoo Finance. I'm Brooke DePalma, live at the NASDAQ. Let's get a quick check on the market action about 2 hours into the trading day. We're seeing all major indices trying to hold on to the momentum there, all three of which have since turned to the red as we make our way into this trading day. NASDAQ really turning up and down on the flat side now. Really, investors here trying to digest some key economic data out. We heard that the JOLTS report from June showed that there were 7.44 million job openings in the month. That was slightly short of the 7.5 million that Wall Street had expected. But the S&P 500 now has reversed the gains that we saw earlier this morning. Any tick higher at market close today will mark the seventh record closing high after 6 straight days of record highs. Now the S&P 500 getting dragged lower a bit. The Dow also falling. That's down the most, down 0.3%. The Dow being dragged lower by both Boeing and United Healthcare, both out with earnings this morning, and both of those companies stock down as well. I do also want to take a closer look at the NASDAQ. What we've seen over this past month is really this rally as these tech giants like NVIDIA have really come out on top. If we take a closer look at the heat map for the NASDAQ, what we've seen over this past month to date is really this momentum within the market, especially led by NVIDIA as well as Amazon. But if you take a look at intraday highs here, NVIDIA hitting an intraday high, and as well as Broadcom, that stock up more than 1% as we make our way into the trading session. Bloomberg Intelligence out with the note this morning saying that NVIDIA and Broadcom have potential for an upgrade over the next 12 to 24 months, being based on strong AI demand, among other factors. Those are two stocks I'll be keeping a close eye on. I also want to get to the euro here. The euro hit a 1-month low against the dollar on Tuesday after the EU and the US have announced that they're going to have a 15% tariffs on those imports to the US. Clearly, that's having an impact here. The euro did slip 1.3% on Monday, and that was its sharpest one-day percentage fall in more than 2 months. Now we're seeing the euro down. If we take a look at intraday, down about 0.5%. What we previously had on was down over the past 20 days. Clearly, the euro under pressure this morning as well. Keep it right here on Yahoo Finance. We'll be tracking all the market moves throughout the session. We'll be right back.
Now time for some of today's trending tickers. We're watching Royal Caribbean, Merck, and Fubo TV. First up, Royal Caribbean shares falling even after the cruise provider raised its guidance for the full year. Shares down over 5% this morning. Royal Caribbean now expecting full year earnings to come in between $15.41 and $15.55. The company credited a stronger than expected second quarter performance, lower costs, and continued favorability below the line. Brooke DePalma is still here. So Royal Caribbean is one of these stocks, though, where we've maybe seen some strength into this report.
Yeah, absolutely. Year to date, prior to the support, the stock price was up more than 50%. And over these past few months, what I've heard from so many experts and analysts is that Royal Caribbean was really seen as a value play here for consumers. Hey, it's the best bang for your buck. But now what we're seeing is that Q3 guidance caused investors to think twice maybe about this momentum that they've had so far. And I took a look at the earnings transcript here, and the CEO there really trying to emphasize that they're on track to continue their earnings growth. But he did say that we're always looking to do more, that these investments that will play itself out here over the coming years, especially on the destination side, really has an opportunity to have a really significant step change in earnings power. So the CEO there really trying to emphasize to investors that there's still a growth story here, especially as consumers look and seek out new ways to save money.
Right. Yeah. And, still up, as you pointed out, quite a bit this year. Let's talk about Merck as well. Shares of that company trading lower after the drug maker announced layoffs as part of a $3 billion cost-cutting plan as it prepares for a $10 billion acquisition of Verona Pharma. That deal expected to close by the end of the fourth quarter. Sales of cancer treatment Keytruda were up 9% in the quarter, but sales of HPV vaccine Gardasil fell for the fourth straight quarter, so that not helping matters either in terms of these shares. Unlike Royal Caribbean, this stock is down already year to date.
Year to date, this stock has been under pressure. It's down nearly 19%. And this is ongoing from over the past year. This stock has clearly struggled to win over investors. In the past year, the stock is down nearly 37%. But still, a call from CFR today saying that the newly launched cost savings initiative targeting that $3 billion in annual cost savings by 2027, as well as the company's continuous focus on innovation, they still believe that it can be a long-term value play here in CFRA's, once again, view. But this is a stock that has clearly been under pressure. Over the past 5 years, though, as we really, since COVID, the stock is up nearly 7%. But over the past year, it's really struggled to impress investors with these cost savings initiatives, as well as in addition to that, once again, as you emphasize, we are seeing that Gardasil shipments to China under pressure as well as weakness there persists.
And finally, Fubo TV releasing preliminary results for its second quarter that are ahead of previous expectations. In North America, the streaming service expects its first half revenue to exceed $365 million and total paid subscribers to be above 1.3 million. Fubo TV will release its full earnings report on August 8th. The company is moving forward with its combination with Hulu Plus Live. It's going to suspend future revenue and subscriber guidance given that, Brooke. And this is a stock, I guess I'm a broken record here. I just keep talking about how these stocks have done over the past year, but this one is up a lot.
Yeah, up a lot. But keep in mind that the stock price is only $3.74 right now. So when you take a look year to date, keep that in mind because it's up nearly 200%. When we kicked off the year, it certainly was at $1.40. So there's been lots of momentum, especially based off of that agreement with Walt Disney earlier this year that they're going to pay $220 million and provide a $145 million loan to acquire about 70% of Fubo. It's important to note here, though, that over the past year, this stock, certainly it's marginal moves here, considering the fact that the stock was only about $1.40 a year ago, and now we're sitting at that $3.73. But, it's an interesting one to watch as this sort of streaming dynamic plays out and who exactly they team up with in this really matters. But if you take a look over the past 5 years, this stock has really struggled to really get in on this game here. We know that the stock is down more than 61%. Back in 2021, this stock was worth about $48. So clearly it's lost momentum, perhaps starting to show some signs of improvement here.
Yeah, well, and we're still waiting for regulators to approve that deal, so we'll see what happens on that front. Thanks, Brooke. And you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Well, U.S. and Chinese officials are holding a second day of talks aimed at extending an existing trade truce. Earlier this week, Commerce Secretary Howard Lutnick says he expects the two sides will agree to another 90-day extension. With us now to discuss, Stephanie Roth, Wolfe Research Chief Economist, still with us, as well as Shahzad Kazi, China Beige Book International Managing Director. And we're still, by the way, waiting for details for the negotiators to come out, for us to hear from Treasury Secretary Scott Bessent. We haven't heard anything yet about how these negotiations have gone. But Shahzad, I'm curious, given your expertise in the China economy, when this all began, there was a lot of talk about their bargaining position. Yeah. Where do you think they stand now?
Well, they feel very confident, which I think is the most important takeaway. If you look at the economic data that came out through Q2 in China Beige Book, the economy is largely swimming in place, which in any other year I think would be concerning. But this year, when you've been hit with unprecedented levels of tariffs, there's a global tariff war happening, and you're still able to actually swim in place, that's pretty good. Plus, they've got a lot of negotiating leverage as they've displayed through the rare earths export controls. So I think Xi Jinping, the Communist Party, they're feeling very, very good about this entire thing.
Well, and it doesn't seem like there is any pressure time-wise, because they've already sort of managed expectations that this is going to be pushed back by another 90 days, right?
Well, I think it seems like increasingly we're willing to just offer up 90 days And I think the Chinese would like the truce to continue potentially indefinitely.
Yeah, I mean, Stephanie, we were talking a little bit earlier about some of the sectors that have been affected. And obviously, the companies that are still reliant on China imports are especially, sensitive to this. I talked to a toy company yesterday, and they talked about that this is really a pain point for them. And by the way, one that they think will last at least into 2026 as they try to make adjustments. So from an economic perspective, what are the implications?
Well, the challenge is because we don't really know where trade levels or tariff levels are going to settle, it's hard to really move production. So at this point, you're going to kind of wait and see, pay the tariffs, and then kind of see how this all plays out. And at this point, certainly toys and games are the sector that's most exposed here from a consumer perspective. That is the category that is most sensitive to imports specifically from China. Then you have household appliances, and then it kind of goes from there. So those are the types of companies I would expect we would hear the most significant pain from. That said, the China tariff rate is starting to converge with tariff rates from elsewhere. So it is possible that it's less attractive to move from China when there's a cost in terms of doing so. We don't exactly know where tariff rates are going to settle. It is possible at some point fentanyl tariff rates could come down, in which case our tariffs on China might actually be roughly equal to where it is from the rest of the world. So at this point, I think what we'll see is companies are going to kind of just continue to do business, which is probably why China's seeing less of an impact than perhaps could otherwise have been the case.
Right. Well, it's also interesting to me, ahead of this, there were reports that the U.S. had offered to pause export controls and maybe to grease the wheels and get things going. And presumably that's something that China wants to hear.
Oh, absolutely. I mean, look, right now, the U.S. position is that we need to concede on export controls. We need to be willing to concede on potentially fentanyl tariffs, do whatever it takes to get that meeting between President Trump and President Xi, because that's what President Donald Trump wants right now.
I am curious, though, the other negotiations and agreements that we have seen still leave a lot of room for ambiguity, don't they, right? Even the EU, the other day we were discussing this morning, are the pharma tariffs, when they come, are they going to be applicable to the EU? The EU seemed to indicate they're not, but it's sort of confusing. In your experience, do you think that China will abide that kind of ambiguity in its agreement?
So look, I mean, they already did that in phase one, right? They made all these commitments to buy so many U.S. exports, and they fell, short, well short of that. So if ultimately the president decides that he wants to do a phase two with the Chinese, they'd be more than happy to eventually settle on numbers, because they know that all they have to do is run out the clock, and they don't really have to live up to any of that, which would of course be a huge disaster. But it seems like that's potentially where we're headed.
Stephanie, you talked about earlier that you had come up with different scenarios for the tariffs and their effect on the U.S. economy, and it's actually worse than you anticipated. What would, specifically with regard to China, what would be a worst case scenario, realistic worst case scenario for the U.S. economy?
Yeah, so the broad set of tariffs has come in worse than our even worst case scenario over the past couple of weeks. We've been keeping China kind of steady because it seems like Trump wants to do a deal with China. So our very much base case across all of the scenarios, or at least on the base case and then the worst case scenario, is that tariffs stay at 30%. So I think the way to think about it is your 30% is probably your ceiling, and then something that's closer to 10% is your floor, and we're likely to end up somewhere in between. So could they go higher? Of course. I think Trump realized that, one, that could mean empty shelves. I think that was a big surprise. And the inflationary impacts of that, I think, has finally gotten through, that we might actually see an impact if they go notably higher than 30%, because you have to add on the tariffs from the last trade war. So now we're talking about tariffs that are close to 50%.
And not to mention the sectoral tariffs, for example, on some specific things as well. Shahzad, to go back to the economic question in China, how do you characterize the Chinese economy at this point, and especially that resilience that you pointed out in the face of these tariffs?
Well, there's a lot of stability that we've seen in the numbers so far. Now, we're going to get our latest readout in a couple of days for July. But you've seen a combination of the economies roughly doing fine, but also that Beijing is stepping up its stimulus measures. So they've kept interest rates at historic lows based on our tracking, and you're getting much more fiscal activity this year than you've had in years past. So I think they're trying to manage the situation. If they can keep the economy humming along, I think they'll be happy with that, and where needed, they're going to provide a stimulus without needing to go, totally bonkers on this and announce some kind of, big, record-breaking numbers of spending.
Okay, Shahzad, thank you so much. Stephanie, thank you so much. Appreciate it. Coming up, much more markets action. We'll also be hearing from the CFO of AstraZeneca after its earnings. AstraZeneca, the pharmaceutical giant, reporting better than expected second quarter results, boosted by its cancer drugs and demand in the U.S. This comes after the drug maker pledged to invest $50 billion in the U.S. by 2030 to build out its manufacturing operations. Joining me now, Aradhana Sarin, AstraZeneca CFO, as well as Yahoo Finance's Anjali Kamlani, who covers healthcare for us. So Aradhana, you did see big numbers in the U.S. Sales here up 13% to $6.32 billion. That's a record. So what were some of the factors driving that record showing?
Actually, it's growth across all our business units. So oncology was really, really strong in the U.S. And across the globe. Oncology actually grew almost 18% in the second quarter. Cardiovascular renal medicines, which is about 23% of our business, grew 3%, and then respiratory and immunology, where we've had a number of new launches over the last several years, grew 12%. Rare disease unit grew about 7%, so it's really across the board and across geographies, but the strongest growth obviously in the U.S. and in emerging markets outside of China.
I wonder, obviously the company is celebrating the fact that you hit the largest revenues reported for the quarter. That's really good news, especially as the stated goal is to grow by 2030 and half of that to be part of the US. Talk to me about that and the shift to being a quote unquote American company now rather than a sort of UK based one that we've thought of all these years.
So we, last May, we set this ambition of achieving 80 billion in revenues by 2030, which was almost, doubling our revenues from a 2023 base. And the U.S. is our fastest growing market. When we don't stack very highly right now in the U.S. when you compare pharma revenues, because a lot of the pharma companies in the U.S. have much bigger sort of revenue base, but we're growing very fast. And our hope is that we'll come, in the top 5 and have half of our revenue. We also set an ambition to have 20 new medicines by 2030, and we already have 9 of them, and we announced results for another 5 of them. So hopefully, touch wood, we're on track to achieve that goal.
Well, talk to me about why the U.S. is growing that much faster. Is it because the dynamics of the healthcare system help boost revenues with more prescribing, the way the PBM system is set up? What are the factors that are helping you grow and are helping you stay confident about achieving that goal?
So there are a bunch of different factors. I think the U.S. is still probably the best market in the world that rewards innovation. And we are an innovation-driven company. And so when new therapies come, we had a product for breast cancer and HER2. We announced data for another breast cancer product. But as soon as new therapy comes, the US market is almost the first to provide access to patients for that new therapy. Secondly, physicians are really, we go to congresses like ASCO where there's tens of thousands of oncology physicians. They're really into looking at the data and making data-driven decisions. So again, the physicians want the best for their patients, and patients are able to get access to medicines very quickly once a drug is approved and so forth in the innovative space. In many other markets in the world, that whole process to get approval and then get access and reimbursement just takes a very long time. So that's one reason. The second reason I think particularly beneficial for oncology medicines is the Part D reform. So on one hand, the Part D reform that was enacted hurts us because we are responsible for paying 20% in the catastrophic phase. But from a patient standpoint, if you're a patient in Medicare, your out-of-pocket is capped at $2,000. So you can get the best therapy and have no more to pay out of pocket, right? So being in that patient population and getting the best access to medicines and the best care and have your out of pocket limited is also great for patients. So I think it's where physicians and patients and innovation is rewarded, and that's why it's growing faster given our portfolio is all innovative medicines.
So let's turn then to the manufacturing base, right, and the investment that you're making in the U.S. And I have to ask about tariffs because, I mean, even as we discussed it this morning, this new EU sort of framework agreement, it's still sort of unclear. Are pharmaceuticals coming from the EU exempt? Are they not exempt? It seems a little unclear. So under what assumption are you operating? And how do you operate in that kind of environment?
I would say this is not tariffs is obviously new, but how we have been thinking about our strategic manufacturing probably goes back 3-4 years. So post-COVID, we made a strategic decision, because we're such a global company, that we needed to have segregated supply chains. So for example, in China, and in the emerging markets, we supply a lot of that product from China. In the US, majority of the product is supplied from the US and so forth in Europe. There is a small minority of product, a handful of products actually, that we still import from Europe into the US. But we do have excess capacity in the US to manufacture those products. So what we have 11 manufacturing sites in the US. So our intention, once the tariffs, et cetera, were announced and there was talks of tariffs, in the short term was just managed through inventory, so build more inventory in the US. But we've also started tech transfers for those products which we do import, and those tech transfers would be completed within a year or so that we can be fully, not just have the majority, but 100% of it being manufactured in the US. This new facility that we announced was part of the plan anyway, but that's it has nothing to do with tariffs. It's actually based on the demand that we see potentially for our new cardiovascular medicine. So, but you're right. I think there is a little bit of confusion on when the tariffs are going to be implemented. There is, from what I've heard, it is a 15%, but there's also talk that that's the cap. And the administration sort of going to wait for the 232 investigation to actually put them into effect or decide. So in either case, I think we're very well prepared. And we probably have less exposure than many companies.
I know you've said that, and I know Pascal has said that as well. I wonder about the sort of global dynamics playing out right now. AstraZeneca does have a really large share of the China market right now, and that is an area where we're seeing growing deals, growing biotech innovation. How do you think that's going to impact the US? Because right now this manufacturing push is a push to sort of salvage the US reputation in this space and attempt to boost presence, innovation, et cetera. How does China fit into this?
So I think one has to separate out a little bit between manufacturing and actual research and development. So manufacturing makes a lot of sense. I think most countries after COVID have realized that they need to be self-sufficient in terms of manufacturing and supply chain. And I think we're very much aligned with that view, which is why we have these segregated supply chains. I think then the question is, where is innovation coming from? Like what labs and what early companies are developing that innovation? And the US has been and continues to be on the forefront of biotech innovation. But China is catching up pretty fast too. And
if I may, do you think any of the research cuts, the funding cuts that we have seen at the at the federally funded level, that they are going to hurt that innovation pipeline?
I think it's hard to say in the near term because so the other thing which I think is unique about pharma maybe versus other sectors is the cycles are very long, right? The innovation cycle takes a very, very long time. And just the development cycle, so i.e. getting a product from the lab to the market, that could be an 8 to 10 year cycle. And then that's assuming you actually have something in the lab. And you were talking about like academic research and so forth, which is even before that. Right. So, the cycle times are very long. So it's hard to today say that that's going to have an immediate impact. But I think the key is for the US to stay competitive both in the early phase of the research as well as in the later phase of the research. So some of the things we're doing, for example, is when we do our clinical studies, so once a drug is already in the clinic, we do global clinical studies, so we have sites everywhere. But over the last several years, again, nothing to do with tariffs or anything, we've been increasing the number of sites that we enroll in the US. And for a number of reasons. One is we also want, I talked about how people adopt innovation quickly. You want the key opinion leaders in the field to have exposure to your drug in the clinical trial so that when it does hopefully eventually make it to market, they already know, how it works and so on and so forth. So, but we need to stay innovative throughout the life cycle of this drug, both from early research, to preclinical, and then obviously on the clinical side.
Aradhana, thank you so much for coming in.
Thank
We
you so
really
much for
appreciate
having
it,
me.
Nanj. Thank you so much. We got much more markets action coming up, including stocks in translation. We'll be right back.
United Health is leading the Dow down today after disappointing earnings. The stock has nearly been cut in half since the beginning of the year, and it's been by far the worst performer in the Dow. But what would the Dow look like without UNH? Today in Stocks in Translation, we're going to take a look at how the Dow is actually calculated. Now, the Dow was born all the way back in 1896, nearly 130 years ago, before computers, before calculators, so this index of 30 stocks had to be easy to calculate. And for sakes of simplicity, only the stock price is used. So the higher the stock price, the greater the weight in the index. And almost every other index, by the way, like the S&P and the NASDAQ, they use a company's market capitalization, but that requires a lot more paperwork and more calculations. So here's the full method. Basically, you sum the prices of all 30 stocks in the index, and then you divide it by a number called the Dow divider, which corrects for splits and changes in the components of the stocks. So anytime a stock has a stock split in the index, or when one stock is swapped out for another one, that Dow divisor will change. Now, here is a list of the 4 top stocks by price. Goldman Sachs is right at the top with $723.65 as of the close yesterday. Microsoft is number 2, Caterpillar is number 3, Home Depot is number 4. Now, United Health has a stock price of about $267 today, but before, just a few months ago, it topped out at about $600. So it actually would have been number 2 in this list had it not seen such a big slide. And I went in and I calculated what the Dow would look like with different configurations here. So the orange line right here, which terminates last, that is the actual Dow. And then when you take out United Health in yellow, you have that line up here. And then I also took out Salesforce, Merck, and then Apple, because those were some of the biggest losers this year by percentage terms. And what you end up with is a materially higher Dow price without these big drags in it. And some of them can be actually quite big. And I also did another calculation here. I took the Dow price weighted, that's the normal price weighting in white here, and then I also calculated it by market cap starting at the beginning of the year. And when you do it by market cap, and I'm just going to kind of trace this out here, we actually saw a lot more volatility by the lows. And again, this just includes all 30 stocks. I'm not taking out United Health or any of them. I'm just doing a different alternate calculation. So more volatility with the market cap weight version that we saw this year. Now, to sum up all the results, here's the market cap weighted 2025 year-to-date return. That came in at 7.3%. The actual price weighted number that everybody uses is 5.4%. And then the Dow minus United Health, that came in all the way up to 9.3%. And then you can take out Salesforce and Merck, and the numbers keep going up. And by the time you take out Apple, we have a Dow that's up 12.4%. And that's more than double the actual return of 5% and change. So something to think about here. There's no guarantee that the Dow will always be calculated like this, but after 130 years, maybe they're just not going to change. Tune into Stocks in Translation podcast for more jargon-busting deep dives. New episodes can be found every Tuesday and Thursday on Yahoo Finance's website or wherever you find your podcasts. More market catalysts after this.
The S&P 500 closing out 6 consecutive record closes. This year, the rally's been led by a small cohort of big tech stocks, begging the question of just how frothy this market is. Joining us now, our markets correspondent Josh Schaefer with our Yahoo Finance chart book. This is the big package of charts we come out with. What is it, annually?
Yeah,
where we
biannually, Julie.
Biannually.
July and then also at the start of the year, right?
Twice a year to set us up for how things are going.
This is our mid-year book.
So is the market frothy?
You ask some people yes, you ask some people no, right? So I brought 3 charts with me today, and
Okay.
we can sort of defend both cases. But I think that was a key debate within our book that has over 35 charts is, are we sort of at a top at this point after we've had this big rally? Are stocks too expensive? So this is a chart from Barry Bannister. What he's looking at here is, as it says there, the enterprise valuation relative to economic profit, essentially how much am I paying for stocks based on what the companies are actually producing in some ways. And you can see here, it has not been this overvalued as Bannister estimates it since 2000, 1999. What is that? Of course, the dot-com bubble, right? And so that is kind of the classic comparison I think we're seeing right now is the question when you think about this AI-led rally is, okay, is it a dot-com bubble style thing? And at least by this metric, you could at least argue from a valuation perspective,
Right.
it's looking a little similar.
I mean, Barry is a noted bear on the market. I mean, there are those who would say markets don't just roll over because of valuation. Something has to happen, right?
Well, and I think you see that here too, right? Look at where we call it overvalued in early 2000. That's a 3-year period that we sat there, right? And so you could also point out, yes, we've started to creep higher here, but to your point, Julie, the question would be what actually makes this matter?
Right.
And you need some sort of catalyst, whether that would be economic slowing, some impact from the tariffs, et cetera. I also thought this chart from Max Grinikoff at UBS was interesting. So you're looking at the discount rate proxy versus the S&P 500 forward price to earnings ratio. This would be kind of a traditional valuation metric, right? And back to Barry's chart, if you looked at the S&P 500 forward PE, it would kind of look similar too. We're definitely in elevated levels here, but what this gap is sort of telling us that Max explained in his commentary is essentially investors are paying a lot for AI exceptionalism. And the question is, does that sort of come through? There is a world where this gap is worth paying more for if I'm an investor, right? And stocks being more expensive. But there is also a world, as we keep talking about during earnings season, where that doesn't come true, right? And then you're perhaps overpaying for stocks at that level.
Okay, and what's the third one?
Our final chart, I love this chart from Todd Stone over at Strategas. So what he's looking at here is the S&P 500 and essentially making the argument that it's less defensive than it used to be.
Well, and what I love about this chart too is it's the inverse of what we tend to talk about, which is that, oh, the S&P 500 is so heavily weighted to tech. Okay, so if it's so heavily weighted to tech, what is it less weighted to?
And it's less weighted to consumer staples, energy, healthcare, and utilities. So you can see that used to be 40% of the index going back about 30 years ago. Now, from a market cap weighting perspective, it's about 22%. And what I think this also tells us in this valuation discussion, normally you would pay a higher valuation for tech stocks or a tech-heavy index, right? Well, the S&P 500 is a tech-heavy index now. So Subir Subramanian in our chart book sort of made that point, that maybe it's worth paying up more and having it be quote-unquote more expensive if you're getting a different product or a different index than you were getting 30
Well, and you could also make the argument that defensive isn't what it used to be, right? It doesn't, you know, there were some who would argue that even tech has defensive characteristics and things like healthcare are perhaps less defensive than they used to be in the past. So these things are all kind of scrambled over time, it feels like.
They are. There's a lot of debate, always is. Makes a market.
That's what makes it fun. That's what makes our jobs fun. And by the way, you can check out the whole Yahoo Finance chart book on our website. And Josh put it together. There's 35 charts there to check out. Thanks, Josh. That's it for Market Catalyst. I'm Julie Hyman. Thank you for watching. We got more Yahoo Finance coming up.